Well, hello and welcome to the Honolulu Hawaii Monthly Housing Report. I'm Patrick ONeill, Principal Broker at Luxury Homes International. And with me today, the president of TZ Economics and Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, good to see you.
Patrick.
Well, I can't believe what happens in 1 month. But there's some pretty
It's
shocking
crazy.
real estate statistics that came out from the latest report from the Honolulu Board of
Yeah,
Realtors.
sadly, yeah.
Sadly, and we'll get to that in just a moment. I wanted to kind of set up our conversation today and look at the broader economy and what's
Mm,
happening to just get an understanding of maybe where we're heading. Last week, the Fed raised their rate another 75 basis points, probably
right.
not a surprise. What I found interesting were the comments that were reported afterwards from various members of the Fed.
Yeah.
Ideally, still a soft landing for the economy,
Mm.
but given the choice, a hard landing or crashing the economy to get a handle on inflation is an option. What's your take on that? And where are we? Where are we going? And what's happening in the economy right now?
Yeah, it's always been an option. It's what they have signaled repeatedly. And as you say, most recently in the wake of their recent decision, their firm commitment, an unwavering commitment to engage should conditions warrant, right? Everything's data driven. And it sounds like tough talk, and it is tough talk. But of course, again, the point is not just to communicate um, in what they call forward guidance, their own ideas of where things are headed, but also to underscore the credibility of their commitment to containing the inflation event that's unfolded in the last 18 months. Um, and an unwavering commitment about which there is obvious disagreement uh, about the extent to which the response will have to be engaged, but you know, uniformly to assure people that there should be no doubt in anybody's mind about the seriousness with which they take the inflation problem and the commitment they have to their own policy strategy of crushing it,
And right
using the
now,
blunt instruments that they have available, which
mm,
obviously have a big impact on housing and unfortunately act primarily through housing and investment generally.
and knowing what you know today, do you think we're headed more towards a soft correction, a hard landing? What do you think?
Um, well, it's a hard landing in housing,
Yeah.
which is kind of our focus today. But I actually think for the economy as a whole, there's still a shot at a soft landing. Um, it's a little confusing because this idea that a recession has to happen is informed by history in which that is how these things have happened. But very often the recessions are precipitated by events like financial crises that aren't rooted in monetary policy. In this case, it's the other way around. The Fed intends to put you know put the brakes on the economic momentum to the extent that that's giving rise to inflation that could spiral out of control if they didn't intervene. And my sense is that they're closer to succeeding at it uh, than than other people might think. But as I say, there's some confusion because we actually had 2 quarters of real GDP decreased in the U.S. in the first half of this year, and in Hawaii, at least one of those quarters. And informally, right, recessions are often thought
Mhm.
of as periods in which output declines. We already had that. It turned around in the third quarter, and that's another one of the uh, complicating factors in the data themselves. Even though this isn't a data-driven project, they're telling us different things at different times. So
Mm.
output's declining, but inflation is rising. Employment's the employment situation is very tight, but now all of a sudden we have some layoffs.
And let me ask you
except they
about
don't.
that.
Yeah,
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 sorry to interrupt, but let me ask you
no,
about employment. So there's been some high profile job layoff announcements, Twitter and at Meta. Is this
yeah.
something that's happening across the board, or is this just very specific to these companies?
Right now, it seems really specific to an industry which, if you paid attention to either the fundamentals in those sectors, so in the case of Meta or Facebook and Instagram, um, they're getting their clocks cleaned by TikTok, and it's showing up in their ad revenue, and that's how they make their money, is by exploiting you to you know uh, push advertising. And it's kind of a weird model. It's great when it works, and when it doesn't, then it's kind of like, well, nobody's paying for what you're providing, so you're not actually going to make money on the on the actual technology.
Right.
With Twitter, it's not so much that been competition per se in that space, but I think, anyway, I'm not on Twitter. I never have been. It's been a place that succeeded in developing these sort of communities, and there are
So,
economists like Twitter universes,
mhm.
but in that case, they've had a bizarre corporate takeover with the bizarre
So these two,
CEO. So
these two are not indicative of what's happening overall in the general economy as far as massive layoffs. We're
yeah,
not in
that's
that moment in time right now.
what's well, that's what's confusing, because we would expect to see large scale layoffs if we were moving towards recession. We would expect to
Mhm.
see involuntary separations in the workplace. But the ones we are seeing well, not all, but many seem to have stories that are either idiosyncratic to the individual firms, or concentration in a sector, in portions of the tech sector that you might have
I see.
said were kind of overdone some while ago. Like,
I
remember
see.
when we were talking about unicorns?
Right.
So it's still very confusing on that score. And by the way, the idea of a soft landing is to get the inflation down without having large losses of employment.
Yep. And speaking of that, so let's segue into inflation and the effect it's having on the mortgage rates right now. So
Yeah,
this was, as of this morning, this is the 30-year fixed,
right.
clearly over 7%.
Yep.
This is looking back 10 years. This is double what anyone who's been in the industry for 10 years or less has seen. Um,
Yeah. I don't think we've
that's
seen anything like this since the subprime bubble, and then not even quite this
and
high.
the
I don't.
yeah, and the buyers and sellers well, so let's say the buyers who've entered the market in this past 10 years, this is
Yeah.
quite a shock.
Yes.
And
Although, if you look at it, I mean, that's a sudden stop for sure, but it does seem to have a little, like, what's that whole zigzag in the summer, right? It went up, and then it subsided, and then it went up again. That's that's probably an information event. You see what I mean?
yes, I do.
Like, when
Hmm.
the Fed began to signal that it was going to have to step in front of the inflation, and that the way that they do this, which is to raise short-term interest rates and to reduce the size of their balance sheet, right? Sell or stop buying mortgage-backed securities, which means there's less demand, which means the prices are lower and the yields are higher as a consequence. When they signaled that, they sent a pretty clear signal, and even a pace at which these events would unfold, that to which they've adhered. Right? They haven't wavered from the path. They raised rates by the right amount, by the amount that they said they were going to. They've reduced the balance sheet by the amount they've said they're going to.
Hmm.
But that little zigzag in the summer had to do with something that happened, as it turns out, in the inflation data, which is they didn't come down as fast
Right.
as would have been necessary to validate the Fed. So it's not the Fed that's changed its path. It's noise, let's say, in the inflation data. And we got an inflation report today. And in fact, the inflation rate did come down by an amount, not just the amount that was expected, by an amount slightly in excess of a decrease, slightly in excess of what it was expected, that begins to take us back to the idea we might have had before the zigzag in mortgage rates that the Fed would succeed. It's just that it's not going to be a nice, inflation is not going to have this nice inverted U
Right.
shape
Right. And we'll probably
profile to it.
bounce around as we try to get to the, what is it? 2 is the number and the number is 2.
Yeah,
Yeah. Yeah. 2.
because it's like 7.7 right now nationwide.
And if we look at this, which is a little bit of a larger context, going back to the 70s,
Historical context, yeah.
historical context, you've said before you think at 7%, 30-year mortgage rates have overshot, and that this probably will
Yeah.
stabilize back in what sort of a range?
Well, I'd say the right number right now is actually closer to 6, but the long-term number is closer to 5. I think it's actually sub 5. If I could, let me show you how this looks in terms of what the Fed itself is saying, right? These are treasury yields, not mortgage rates, but mortgage rates are essentially, you can think of it as the 10-year yield or the 7-year yield plus 2 percentage points or something like that, 175 basis points. Here's what the Fed's told us about what it's going to do as of September. Now in October, they raised the overnight rate right up here, into this neighborhood. It's a little faster than they've indicated, and they're now talking about going as high as 5, right? Some of the Fed governors. Some of the Federal Open Market Committee participants, which include Fed governors as well as Federal Reserve District Bank presidents, a subset of the 12, I think it's 7. So we've already known that they were expecting to have to overshoot on rates. And therefore, when you fast forward to the mortgage rates, what I'm suggesting is that this part right here is an overshoot, that somewhere in this area is where we could be in the not too distant future. And then I have to skip over all this other stuff in between. If you think about where the long run is as a terminus, an overnight rate of 2.5%, and let's say a 3% yield on the 10-year Treasury note would be consistent with something that's more like a 5% mortgage rate. You see what I mean?
I do.
Then, which is kind of the upper bound of where we've been over the last decade. I don't think that going back into the 1970s or even the 1980s is particularly instructive anymore, because the inflation environment there not only exhibited periods of double-digit inflation, although passing, it was characterized by an ambient or average inflation rate that was more like 4% than the 2% that we've had in this country for the last decade, at least pre-COVID and during COVID, really until March, the spring of 2021, which is not that long ago. And the rate to which not only has the Fed committed itself, I believe credibly, but most people still seem to believe. Like if you look at expectations, they're not that much higher than what the Fed's looking at.
Yes. Okay.
And a lot of what you can see, for example, in the difference between Treasury yields and inflation protected securities, TIPS yields, a lot of that difference is really a risk premium, right? The risk that inflation is going to be higher, not the expectation that inflation is going to be higher. So.
Yes. Okay, good. Well, I mean, I think overall that sounds pretty good.
We'll get there. It's going to be it's going to be another tough 12 months.
Yes.
That's,
okay. Well, speaking of tough, let's shift over to the real estate report. And actually, Paul, let's take a quick break, and then we come back. We're going to jump into the numbers and some pretty shocking ones at that. So we'll be right back. Don't go away.
Sounds good. Yeah.
Okay, and we're back with Hawaii's favorite economist, Mr. Paul Brewbaker. And Paul, we're about to jump into the statistics from the Honolulu Board of Realtors, just released, hot off the press. And I thought what might be interesting, again, to give us more context, is to go back and look at the other 2 cycles that we most recently went through. So here's the Board of Realtors statistics, but we're going to start here. It's a lot of data here, but this is the median pricing for single family homes, the run up for the Japanese bubble period, the run up for the subprime bubble. And then finally down at the bottom, I know you don't like bubble, and there's a lot of reasons why this isn't a bubble. I'm just calling it the single family home bump. How's that?
Sounds good.
For COVID. All right. So we can see the percentage increases, and I think we'd all agree that this certainly was a bump for the single family homes. So this is where it kind of gets interesting. I've underlined the years after the bubble burst, so to speak.
Okay.
And we can see Japanese bubble period down 30%, subprime down almost 25%. Now we're in the COVID bump period right now. So actually, from 2021, the number is up. But we are right now actually 18.5% decline year to date through October. I suspect this number is probably going to be higher, which might suggest that we are in the correction maybe of the bump, which kind of brings us back. This is the year to date number. And I'll go through the rest of these closed sales figures. So here, single family on the left, condo on the right. Closed sales month over month down 20%, 12.3. And this is huge for single family home compared to last year. Almost 42%, condos 29%. Do you suspect that well, I think it's pretty clear right now, we are in this correction, aren't we?
Yeah, but this is two things, right? One is the fact that it's interest rates that are doing it, but the other is that single family home prices went up. Single family homes had the juice after the pandemic changed the way people worked and where they worked and housing preferences as a consequence of that, but not so much condos. So you see all the movement on the way up in the single family homes and not that much of it on the way down in condos. Condos also had the right. I mean, I've shown you these pictures before, and I'll show you them in a second. But condos also were kind of tainted by the political brouhaha over vacation rentals on Oahu.
Yeah, that's true. This is just looking at a little bit longer chart from our pre-COVID moment, single family homes on the green line. This is the first time we've dipped below through this COVID period as far as number of closed sales. I think just sort of confirming that certainly we're kind of heading in this direction.
Well, 7%, that's a mortgage rate. There's a slam dance on the housing market like we haven't seen for 15 years.
In the past two cycles, Japanese bubble period, subprime, were there also similar increases happening from the Fed to slow things down?
Yeah, go back to your annual slides where you showed first you circled the bubbles and then you had an underline for go back about 5 slides, I think it is, to the moment after the bubble. And we can draw that distinction. Let's go back one more slide first and remind ourselves at the peak, what was happening, 89, 90, 2004, 2005, and then 2021. And one thing to notice right there, and by the way, the 2022 number by the end of this year is being dragged downward, right?
Yes.
So by the end of it's not going to be 13. It may not even be double digit. So what's different about 2021, as you look at this, and these are single family homes, but if you look over to the right where you haven't circled, you can see the condos are like 9. You know what I mean? They're not double digit. Right. That's an important distinction, the one to which I referred earlier. But the juice was in single family, but not in condo. But look at the condos in the Japan bubble and subprime bubble era. They were double digits in both segments, almost by the same amounts, and even more in the Japan bubble and the condo segment. So that's one big structural difference between what just happened and what happened in the past. You were talking about interest rates. So let's go to let me first say this, that ask, what was the Fed doing in 2021? The answer, nothing. No change in interest rates. People knew that at some point they were going to have to normalize interest rates, but 2021, we had 3% mortgage rates. The Fed was keeping the overnight rate near zero, and everything was, let's just get the economy back on track.
Yeah, that was the fear then. We've got to have these low rates to keep the economy alive.
let's go back to the slide again and think about 1989 and 1990 and think about Fed policy. 89 and 90, what was happening with Fed policy? Alan Greenspan, who'd just been appointed to the Fed before the stock market crash in 1987, Alan Greenspan, for the first time in his early in his tenure there, was raising the Fed funds rate, was tightening monetary policy in the late 90s. Why? In the late 80s. Why? To keep inflation in check. And by the way, in Hawaii, inflation in 1990 was higher than it is today. And that's not 40 years ago. So every time you hear somebody on the TV say it's the highest in 40 years, just remind them that not in Hawaii. But the same thing was happening in 2004, 2005. What was Alan Greenspan doing then? He was saying, under these circumstances, policy accommodation can be removed at a pace that is likely to be measured, which meant the Fed was raising interest rates in 2004 and 2005 and all the way through in the first half of 2006. So in both cases, 89, 90, the Fed was breaking. What was the Fed doing in 2021 again? Nothing. That's a big difference. The Fed now has moved. Yes, 2022 it's moved. So when you go to your next slide and you've underlined the year after, right? After the party's over, and you see those big declines in sales volumes, both on the single family and the condo side in the Japan bubble period, as well as in the subprime bubble period, right? Those declines had been unfolding even before the Fed tightened. Look back in 1988. Sales were declining in 1988, the year after Alan Greenspan was appointed to the Fed and was not raising interest rates. Sales were declining already in 2005 when the Fed just got started raising interest rates in baby steps, 25 basis points per meeting, every meeting for 2 years, every 6 weeks for 2 years, at a pace that is likely to be measured. So in those two circumstances, sales were declining either at the time or prior to the time Fed policy changed, whereas here, they didn't even decline until this year. They didn't decline until after the Fed raised rates, and Fed raised rates this time faster than it ever has.
And Paul, let me point out one other thing. I didn't highlight this, but I do recall this, and I can see it in the numbers. Subprime bubble, when that burst, really, 2008 for sure, it was devastating. But 2007, prices were already coming down in Hawaii, some of the things that we were doing. But you'll see sometimes during these periods, the median price will continue to rise, it'll jump, it'll go up and down. But when we look at individual neighborhoods, individual condominiums, like right now as an example, we certainly see prices coming down faster than comes up in the statistics in the median price. Is that just a shift in the mix and there's less homes available?
Yeah, but you need to go back to the underlying slide because this is a really important point you're making, Patrick. And we were just talking about how sales were falling in the next slide. Sales were falling contemporaneous to the Fed tightening or even slightly before the Fed tightening. Why were sales declining from 1988? We think of the Japan bubble as, oh, it's a bubble. Yeah, it's a bubble in prices. But sales were falling in 88, 89, 1990. Year after year after year, sales are falling. How good is it to be a realtor when the sales are dropping? Why were they dropping? Because the prices were going up so much, they were completely unaffordable. There's a big difference between having high prices drive this drop in sales volumes and high interest rates cause the drop in volumes. Prices weren't as far out. I know people are concerned about housing affordability in the current environment, and then, well, they should be. And yes, you're right. There are compositional effects. What happens is that there's still a few people buying at the high end. But what was happening in those earlier periods is sales were dropping across the board. All prices had gone up so much, not just the high end, let's say. And all prices were out of reach. And then, of course, with the interest rates that were rising as well, that compounded the problem. But I think it's important for us to distinguish what we've just gone through in the current cycle from what we've seen, that's what I mean. I'm really troubled by historical comparisons, and I'll make this even more explicit by just reminding everybody that what happened in this bump was that single family valuations busted a move. And however scary $1 million and however scary $1 million as a median price was in people's minds, and whatever's going on in their conspiracy theory, polluted minds, it was going to be $1 million in the middle of next year anyway, at the rate things were already at the steady pace of 4 or 4.5% that home prices were right. We were going to be there anyway. So prices coming back from 1.2 million in the single family median, from 1.2 million to 1.1 million, or when prices were going to be $1 million next year if you just waited 5 minutes. That doesn't sound like an affordable housing crisis.
Right. And then we know our affordable housing crisis here has nothing to do with that. That's just a whole nother story.
It's a supply.
Yes.
It's a crisis in the provision of housing.
Yes.
Not the valuations of housing.
Yeah.
The valuations are eminently fair.
Yes.
We just aren't allowed to build as many as are needed.
Right. Okay. So let's take a real quick break. We come back. Let's see what the future holds by look at the pending sales, and then we'll also take a look at pricing. Stand by. We'll be right back with economist Paul Brewbaker. Okay, and we are back with the economist Paul Brewbaker. I'm Patrick ONeill, principal broker at Luxury Homes International. So, Paul, we've been talking about closed sales, and now we're going to kind of peek into the future by taking a look at the pending sales. This is the data that was just released by the Honolulu Board of Realtors. And let's take a look. So here we go. Pending sales. This is really the most dramatic number in this whole report. Down 50% for single family homes and almost 46% for condominiums. This is showing us what we're going to see next month, right?
Yeah, I mean, this says at 7%, it's time for you to go on vacation. Take a long winter break. Come on back when the mortgage rate is 6%. And we can start talking. We can revive the conversation that was rudely interrupted by the Fed's need to tap the inflation down before it got out of control.
Right, and all of this, other than the interest rates right now, probably is going to end up being good news for buyers, right? We'll more than likely see some correction in the pricing as we go forward.
In the short term, it's clearly shifted from a seller's market to say that again.
Seller's market, seller's market to a buyer's market, right?
To a buyer's market. But again, in the broader scheme of time and history, the valuations themselves aren't really misaligned with the fundamentals of appreciation or economic activity or potential generally here in Hawaii. I mean, we're not unfairly valued. We got a little out of alignment in the single family space, but we knew that had to do with remote work, and things changed after the pandemic. This is saying right now 7% is the kiss of death.
Yes.
And you're just going to have to keep your powder dry, both buyers and sellers. But
and let me
powder dry until you get back to something that's more manageable in the 5 to 6% range, which by the way, we're not going back to 3%. That ship sailed. We're probably going to go back to something closer to 5, and most of the 20 teens were in the neighborhood. We're in a range of 3 to 5.
Right.
Like 5 was the upper bound of most of the last decade.
And during the subprime, and during the subprime bubble, no one talked about how high interest rates were.
It's not going to happen again.
Let me compare the pending sales dramatic numbers against the active inventory, which is very dramatic for single family homes. It's still up for condos, 15%, but active inventory is up almost 64% for single family homes. I mean,
Yeah.
inventory going one way, supply and demand heading against each other. Clearly, prices are going to start to move, wouldn't you think?
Piling up like a wreck on the highway.
Yeah. Okay.
Yeah.
And then, so Paul, we were going to shift gears. We don't normally talk about this, but to talk a little bit about currency, and in particular, the yen
Yeah.
against the US dollar, which certainly impacts Hawaii and the visitors coming, as well as the Japanese market as purchasers.
Investors. You
So
bet.
let's
Yeah.
just take a super quick break, and we're going to come right back. We're going to talk currency
Okay.
with Paul Brewbaker. Stand by. All right, and welcome back to the monthly housing report with economist Paul Brewbaker. And by the way, if you've enjoyed this today, please do consider giving Paul a thumbs up down below and subscribe to this channel so you don't miss the latest reports that come out. So, Paul, a key part of our economy in the tourism sector are the Japanese visitors.
Yeah.
And also in the real estate, certainly in the high end, and there's certain buildings that are, 90%.
More than any other offshore investor than foreign investor than maybe Canadians. Yeah.
Yes, right. And the yen is really down against the dollar. Can you tell us a little bit about this and what you think the
Yeah.
impacts will
Well,
be?
yeah. I mean, the dollars, because of our high interest rates in the U.S. and really the Fed leading in terms of how aggressive its anti-inflationary monetary policy posture is relative to other countries, and therefore relative to other countries' interest rates and exchange rates as a consequence. We're so far out ahead of that. Our rates are so much higher, or have moved so much more quickly upward, that the dollar is strong against all currencies, not just the yen. But as you point out, the Japanese traveler has historically been important. They've been absent because of COVID and uh, quarantine requirements for travelers in Japan, and just a general biological risk environment, particularly for international travelers. It's a more tangible concern than it is, going on a road trip in your own state or in your own country. But a lot of excitement about the restoration of travel from Japan. And I think it's one of these areas where we just have to be a little more careful about containing our, curbing our enthusiasm, so to speak. And that may translate into the residential investment space as well. So here's the relationship between the yen dollar exchange rate and Japanese spending, visitor spending in Hawaii. And basically, we're at 140 to 150 yen per dollar now. I haven't updated this for a while. Of course, we've had no Japanese travel for a while from which to really calibrate. But it's off the chart. It's literally off the chart. At 148 or whatever yen per dollar it would be today, you would expect Japanese to be spending, if there were large numbers of them, and we had lots of observations, about $200 a day instead of the $300 a day we've seen under other circumstances. So right off the top, $200 a day as opposed to $300 a day, what's that change going to come from? It's going to come from discretionary outlay, because like the fixed cost of travel, which is lodging, it's fixed costs. Not only is the hotel are the lodging services providers not reducing their rates or their service charges, which is like, what's up with that? The resort fee. Not only are those prices not coming down, they've been going up in dollars. But because of the yen's depreciation, that means they went up even more in yen. So the carve out for the fixed cost of travel, which is the overnight stay, is way bigger right now for a prospective Japanese traveler. And of course, the city council has banned all the vacation rentals in places that Japanese like to go on the windward side, like Kailua, where I live. And angry Kailua people want people from other places to get out of their neighborhood. I'm like, whoa, what's that all about? Well, it is what it is, as Donald Trump loves to say. And here we are with a weak yen, a prospect of returning Japanese travelers who will have to pay super high lodging rates in the places they're now obligated to stay, in the resort areas, in the global lodging brands, very fine uh, um, uh, lodging venues, but there's not going to be that much left over
Right.
for shopping.
And the only thing that will bring this back into alignment or correction would be the drops in the rates, because that's what's pumping up our dollar right now against these other currencies.
Of course, it's the relative rates that matter. So there's that history of the yen. It was very different back in the 70s and 80s when the yen was a weak currency, but the yen became a stronger currency. It tripled in value. That, you want to think about what was driving the Japan bubble.
Yeah.
The yen tripled in value. That meant that real estate in Hawaii at the end of this transition was 1/3 as costly in yen as it had been 20 years earlier. But those days are over. And this more recent 30-year arc has led us to a point right now where the yen dollar exchange rate is at a point where the yen is as weak as it's ever been in the last 35 years. Otherwise, Japan's experience, for example, with inflation is not that different from the rest of the advanced economies. The current inflation event, the post-COVID inflation event, is a shared event. The pandemic was a global phenomenon, and the post-pandemic inflation is a global phenomenon. It's essentially the same in the European, in the right, in the eurozone, if you will, or say in the UK, as it is in the US. Now, Japan, it's qualitatively similar, it's quantitatively distinct, but Japan has been quantitatively distinct for a long time. For that same 30-year or so a period, Japan's had zero inflation. Our goal is 2. Japan's had 0. And so for their inflation to go up 2 or 3 percentage points is essentially the same experience. And as a result, both in Europe and in Japan and elsewhere, to different degrees, because sovereign states, have their own approaches to this, those countries' interest rates eventually will have to move upward if they're to contain the portion of the global inflation that's coming from whatever's happening in their own economy.
Yes.
What's the other portion of the inflation? It's the supply chain disruption. It's the fact if you can't get semiconductors, then you can't get cars.
Monetary policy is not going to change that.
That's not going to change.
That's going to be fixed in
if the Russian invasion of Ukraine has cut off the supply of natural gas to Europe and they're turning to oil and it makes oil prices higher, then there's nothing the Federal Reserve can do about that. If the grain harvest in Ukraine is not making its way to the global market because there was no grain harvest in Ukraine, that's on war. That's not something monetary policy. And people need to recognize that they too are going through the consequences of the war, that they too are going through the consequences of lingering aspects of the supply chain disruption that accompanied the pandemic.
Yes. Yep. Okay. Well, Paul, as always, it's just so enjoyable and getting your insights on all these. Really appreciate it and look forward to next month. And for those of you that are watching this on replay, do give Paul a thumbs up down below. Let him know you love him, and consider subscribing to the channel. You'll get next month's report. So that's all for now. We'll see you soon. Be safe, be healthy, and aloha.
Aloha.